Weird. All right. Well, hello and welcome, folks, to another Tuesday night of the happenings in the world of mortgages, the happenings with velocity banking, strategic debt paydown, all things financial freedom. This is what we're talking about tonight. Now, remember, as we start to go through these financial strategies, we talk about current events, things that are happening, legal issues, concepts, also financial strategies and things like that. Just remember, this is general information in scope. We always recommend that you engage the services of that specific professional that is needed for your specific situation. Now, of course, we are here to help guide you to that, whether it's Richie or myself helping you out, or we can definitely connect you with one of our other professionals if you need like an attorney, something like that. But we are here to help guide you through what is happening and staying up to date with what is happening. My name is Ray Fleming, and Mr. Richie GP.
Oh,
We are the Wise Guys in Ties, and we are bringing another episode of happenings in the mortgage world. Right, the rates are on the rise, and how to really start to get back on track with the velocity banking. Because hey, it was interesting. There was some refinancing that was happening last 2 years or so, 3 years, when the rates were really low. But then now are you going to be refinancing into a 7% mortgage? I don't know. If you're thinking about it, let's definitely look at the numbers, because does that make sense anymore? We'll have to see. Not sure. So, Mr. Ritchie, you're going to be guiding us through tonight and really helping us see what's happening in the market and how everyone at home can really take the reins when maybe they feel like these rates are a little out of control.
Roger that. Yeah, they are. I gotta say they're getting up there. But the cool thing about it is those who know how to pay the least amount. Those who don't know, well, they're going to be the status quo. They are going to be the people who don't know. These are the people that are going to pay the most. Okay, so this is why we talk about these strategies, not only just because debt pay down and such, but to keep more money, your hard-earned take-home pay, in your pocket. Keep it there as much as possible. And it's me and Ray, we've been a part of this group that's like one of our first steps is being able to recover cash and keep as much of it as possible, aside from the most people paying pretty much a third of it to taxes and a third of it to the banks. We wanted you to keep as much as possible in your pocket. And so there's been a lot of really cool I guess information tidbits out there, especially from our group, about how to not pay 33% to interest and 33% to taxes of your total income, but shrinking it down to like maybe 5 or even 10% of those totals. Therefore, you get to live more. You get to live and keep your money and do the things that you want to do more. But with these interest rates climbing, it's freaking a lot of people out. But again, those who know, like myself, not freaking out whatsoever. Even if it does climb up to the double digits, not freaking out. And the reason why is because I know a lot of things, and I know how to, I guess, survive all of this going on, and keep up with what we need to do to make sure that it's not a detriment to me and my family. And that's why we want to share with you. Okay. Now, we are the Wise Guys in Ties. We've been, doing these masterminds for, the last year, more than a year now. And it's just been phenomenal to see the differences between all the bank product that we've been seeing since we started doing these, and even before, especially before. My goodness, we as real estate investors were having issues trying to get appraisers out to our properties to to basically see how much we could actually borrow from a property, or how much we could sell a property for, or if we have a buyer, see how much they could actually borrow for it. Because there were so many refinances and purchases on property that appraisers were just so booked out. Now, this last flip that I've been working on this whole entire time since last year, really, we were coming to the end of it in February, but it just got stretched out till now. The appraisers were so booked out, they took so long. And unfortunately, though, these particular appraisers decided, you know what, if you want to be on our A table, so to speak, pay us more money type of thing. Well, you know what? Now that nobody's going to be getting refinances and purchases, these appraisers are going to have a very tough time finding work. Just throwing that out there. And it was really funny because I was talking to my broker about this, my lender, my I guess you could say my funding broker, where he coordinates all this stuff, and it's frustrating the heck out of him because he's over here saying, I got to actually drag more money out of my clients just so they can get an appraisal done faster. And it's ripping everybody off and so on and so forth. But as soon as things start tumbling down and these guys are trying to get work, we're not going to give it to them. So I felt that was very interesting. Not to start off in that sense of negativity or anything like that. It's just weird that so many things get affected by these small things the Fed is doing.
Isn't that considered like highway robbery?
Totally, absolutely. And so here we are with solution-based thinking here. That's all we've been doing is just solution-based thinking every single time something comes up. And if you want to be that solution-based thinker, please join us. As the Wise Guys and Ties always think about the solutions to make a positive result and win-win solutions all around. So we last week started talking about the whole mortgage rates and everything like that. Whoever's gonna be buying a house right now or in the near future is going to have to suffer through these specific rates until the rates start dropping, the economy does what it does, and therefore you could refinance and all these other things that you could do, right? I want to make sure that you understand the I guess everything that goes along with that, running the numbers to make sure that you make the right decisions as you go through this stuff. Initially, it's always going to be a great idea to get into a property, and it's going to do its thing. You're going to have a place to live, or if it's an investment property, and so on and so forth. But once you start looking at all the financial details about it, how much interest is it going to cost you if you stick to the standard payments, if you use velocity banking, if you double pay, if you prepay your mortgage, if you snowball it, and all these other really great strategies are out there. What are the actual stipulations if you were to take the next step, right? And one of those steps that a lot of people are looking at right now, believe it or not, still yet, is the home equity line of credit, or even a first position home equity line of credit. Now, I told Ray that we have a little treat today because one of the things that I barely ever talk about in these masterminds is how I found out, or how underwriters work when they qualify people for a home equity line of credit. Whether it be second position or first position, they want to know if you could qualify. It's all about risk mitigation. It's all about making sure that they're warm and fuzzy when they lend you the ability to borrow from your equity. And things change. Even their qualification process changes along with the mortgage rates that are out right now. A lot of people don't realize that mortgage rates are very strongly connected to how banks qualify you for other ancillary product that they offer based on the security of a house or a property, okay? And I'm going to show you an example of that today. How someone would want to run their numbers to see if they could actually qualify for a home equity line of credit right now, even if they have a loan from 2 or 3 years ago and they want to try and get one right now. Now, last time we talked about just going ahead and using a chunking method to pay down the mortgage as quickly as possible. The very basic standard addition of velocity banking. But what if somebody does want to apply for that home equity line of credit right now with the particular rates that are on right now? A lot of people don't realize that today's rates affect your qualification strategy. It affects the way the bank looks at you if you want to borrow against your house, regardless of what it is, whether it be a mortgage refinance or home equity line of credit. Those rates change everything. So I'm going to show you an example of how it works with your, a couple of years ago, how they basically qualified, well, myself when I got my first home equity line of credit. And then as the rates change, so does their debt to income ratio, I guess calculations change based on their new numbers, based on the new rates that are out for the mortgages. So today, Ray, have you looked at today's mortgage rates? You're muted.
Sorry, I had something in my throat. I have not looked at today's rates. Now,
Cool.
I did see the national average percent though.
Gotcha. Let's
from yesterday. So what
let's-
people were getting actually the average of approval yesterday.
Let's look at today's rates. And again, this is just average rates based on Google and the information that they gather. So I'm just going to share with you my screen here. And as you can see, we're looking at 6.75 for a credit score of 700 to 719 on average. And if you were to bring it up a little, then it drops it down below 6, which is a wonderful, wonderful thing, which is, again, the reason why you want to have your credit scores as low as possible or as high as possible when you apply for these things. But if you go below that, we're hitting the 7% mark, Ray.
Yep.
It's unprecedented.
Wild.
We haven't seen this since before the crash.
Yeah, I was gonna say it's 2000. Yeah, I'm just trying to remember last 6 or 7% mortgages. When were those started?
So 6, I remember 6 being in around the 2006, 2007 era.
Perfect.
Before that, I think it was a little higher or whatever they did. It all depended on when the recessions were happening. Sorry, turn that off. When the recessions were happening and how the banks basically reacted to the Fed doing their thing. So as you can see, the banks are reacting quite significantly, actually. So if this is on average 30-year fixed rate at 6.75, then what you got to realize is that the bank is going to be using this as a tool for their qualifying product for anything tied to a property. Okay. Now, this was from last couple weeks ago, where we were running these numbers and we're seeing, the rates, the interest rates and everything like that on the first position home equity line of credit, moving it over at 6.5 and so on and so forth. So what I'm going to do is I'm going to bring this back up to a mortgage. Okay. And we're going to calculate this out real quick with our trusty 10B2 calculator using today's new rates. Okay. Actually, no, I'm sorry. We're going to begin as if you had a mortgage for the last couple of years, and then we're going to look at today's rates. Okay. So let's just say this person had a $350,000 loan from back in, say 2016. So we'd probably be at the 4% rate at 360. Payment being 1670.95. Okay, so that means that by today, so let's say this is back in 2016. By today, the balance should be at, so here we are, April 2022. There we go, 72 months in. We're 6 months in. So our balance should be at 309.40. Okay. So 309.40 is where the payment should, where the balance will be. So I'm just going to pop that in here. 309.40. Yeah. 040. Rate being 4%. Principal and interest payment being 1670.95. Okay. And, I like to use a typical escrow payment and just add these two to the total monthly payment of almost $2,000 basically on a $309,000 balance. And since this person's paid 6 years already, then they have 24 years left. Okay. Now, what this person is trying to do is, let's say, like this is where they're at right now. They want to use the velocity banking strategy, and somebody pitched to them saying, "Hey, you know what? A home equity line of credit would do wonders for you." Okay. Now, in this case, we're looking at a good cash flow of 2079. Income is $9,000 total. They got total take-home pay $6,500 a month. Fixed debt expenses, which is the mortgage and whatever else, and then living expenses $2,500 total. So we're looking at what the bank sees as a 21% debt to income ratio based on the gross income, and dividing that by the debt. The debt service payments that they make every single month. Okay, so the debt service payments is so here we're looking at 4420 here. Okay, some things are not showing up on here, but yeah, 4420 total on debt service payments. Actually, no, it's 1920 debt service payments, not the total expenses, just the fixed expenses. So 1920, 1921 is the debt payments. Therefore, the debt to income ratio is 21%. So taking 1921, which is what the bank sees as your payments every single month to debt service, divide that by the gross, and what you get is a 21%. Okay. Now, the lower the debt to income ratio, the better the qualification is. Meaning that if we were to drop this number, so say we change this to let's say $50, so it saves $200. You could see that the debt to income ratio drops because of that, right? Of course, if you add more, then it brings it up. In fact, if we added more minimum payments to something else, like let's say we put a loan in here and it's going to cost us $500 more per month, we end up getting our debt to income ratio higher by doing that. Okay. So see how it transforms the way the bank looks at you, your monthly payments, your debt to income ratio, your debt service payments every single month, okay, against your gross income. Now, if we're going to be using this particular property, and let's say it's worth $450,000, right? We got some equity there, don't we?
Yeah.
So judging by this, let's say the value is 450 and you are looking for a bank. The bank offers 80% loan to value. So therefore you just basically take 450,000 and then you multiply that by 80%. And what you'll get is 360. That's how much you could borrow up to against your property. And in this case, there's a balance of 309,000. So we're going to have to minus that from here to see how much equity you could actually borrow from the 80% loan to value. Minus 309,040. They would grant you 50,960 maximum on this home equity line of credit. Again, whether it be second position, first position, doesn't matter. Just as long as you know that they could actually offer up to $50,960. Now, this is only up to this amount according to if the person can meet now the debt to income ratio standard. Now, not worrying about credit score or anything like that. By this point, when they calculate all this out, they had already proved you passed credit scoring. That's their first, hurdle. If your credit score meets their minimum requirements, then that's the first hurdle. Then they calculate how much they could actually let you borrow. That's the second hurdle. Third hurdle is to see if you could actually afford borrowing $50,960 according to their standard. Now, when most banks see a mortgage, okay, what you got to realize is that mortgages are usually made up like this. So here's a line of year 1 to year 30. Okay. Pretty simple, right? This is a mortgage, this is a regular mortgage. And this is how they usually look at your mortgage. And in this case, this person has paid up to this point. So 6 years off, 6 years paid in. Okay. They're at this point right now. Now, if they were to look at a home equity line of credit based on this mortgage, what they would actually do is they would take your mortgage, 1 to 30, and say you have a 10-year draw period on the HELOC that you're borrowing from, okay? Meaning that over here is the 10-year draw period limit, meaning between the 10-year and the 30-year, you have a 20-year balance. Okay. So if you were to apply for a home equity line of credit, this is how they would look at your ability to borrow from them. This is just the tip of the iceberg. So bear with me. Okay. They would let you draw from the home equity line of credit for up to 10 years. If it's a different bank or, a different product, they would let you borrow, maybe do 15 years or even just 5 years or whatever. But I'm just using 10 year as the example. This is how my home equity line of credit was modeled out. And then after the 10 year, if there was a balance on the HELOC, I would have a 20-year payback or 20 years worth of payback to for the balance that I owed. Okay. So let's say, I qualified for just like this, $50,000. And let's say I used it, right? I used it just like a savings account. I just went ahead and spent it. I used it to fix up my kitchen, or I did something else or whatever. The $50,000 balance would be over here in the 10-year. And if the balance carries over into the 10th year, they stop me from drawing from it. In other words, I cannot draw any more out of this line of credit anymore. Even if I put money into it, I cannot draw it back out. It is now on a 20-year mortgage payment. Okay. Meaning that if my original mortgage balance was 300, what was it again? 309.4 or 309.40. Okay. My original mortgage balance was 309.40. 040. What they would do, and say this is a second position home equity line of credit. This is a second position HELOC. Okay. Let me just go ahead and write that down here. What they would want to do is make sure that you're able to pay this $50,000 back and this $309,000 back between year 10 and year 30. Okay. In other words, they would basically use this as their test to qualify you if you were to be able to, carry this on and see how it affects your debt to income ratio, the payment itself. So what I'm going to do is I'm going to act as if we took $50,000, carried over to the balance. And now what we got to do is look 20 years. It's 20 years, 240 months of payback. Now what we got to do is look at the current mortgage rates as of today, not the 4% that you borrowed at originally, but today's mortgage rates. And depending on your credit score, right? So say your credit score is that 700 and above, that means that the 6.75 would be in effect. And this is basically what your payment would be on this loan as you paid it back over 20 years. They would add this over to the numbers that they ran. So say, they'll just add this as a minimum payment of, was it again, 380. And sure enough, you can afford it. They would actually definitely grant you this $50,000 line of credit, using this as their their payment test if your debt to income ratio can meet it. And this is where a lot of people tend to say, well, you know what if I just went ahead and did the whole first position home equity line of credit? Well, then it becomes harder. All right, because now you're not just looking at this $50,000 balance anymore. You're actually looking at this balance plus the 50,000. So let's say they wiped out the mortgage and put it into here plus 50. So let's just call this 359. Okay. You would use it, carry it over, and then you'd have 20-year balance to pay it back or 20 years to pay it back. And they want to know if you can actually afford that in today's mortgage rates. So the way this would work is you take 359, 040 at 6.75 for 20 years, payments 2730.01. Okay. Now, what's cool about this is that this goes away, right? Because they no longer have this payment anymore. But what they do want to know is if you can afford this new payment based on today's mortgage rates of 2730. Look at your debt to income ratio and it hits 30%. In this case, yes, it can. Okay. Again, this is based on the gross income up here, this $9,000. And using this as the payment structure for the next 20 years after you use the line of credit for 10 years, they would use that as their test to check if your debt to income ratio meets their standards. Now, if your income goes up or down within the term, it doesn't really matter to them. But if it happens to go lower before you start the HELOC, let's say we dropped it by $2,000. So now our income is $7,000. Our debt to income ratio is at 39%. In this case, you still can afford it, right? So it all depends on the numbers and how they will look at you once you start doing your thing. But of course, you always want to make sure that your cash flow is in the positive as well. A lot of people say, I'd like to have this for your Velocity banking fee. Quite honestly, I'm all about just positive cash flow, regardless of the amount. If you can make positive cash flow in this case, then that means that you can make more positive cash flow. Whatever you're doing right now, add something to it. Whatever you're creating right now, whatever solution you're creating, whatever value you're creating to other or bringing to other people, you can make more. Therefore, you should be able to make more eventually. But to me, positive cash flow is always a win. And as long as you have that positive cash flow, you should be fine to float at least until you start making more income. And when you make that more income, then you should be able to pay the debt down faster. But the reason why I wanted to share this today is because I know that I've been getting this question a lot lately when I talk to people about the new interest rates and people wanting to get into the HELOCs anyway, especially over here in Hawaii, because the rates are amazing over here for promo rates. But a lot of times people don't realize how much today's rates are affecting their ability to borrow from the bank right now. I'm just gonna be honest with you. It seems like the banks are very, very wary. They're very they're very wary. They want to make sure that whatever they lend out right now is going to be paid back. And this is where it becomes a very strange issue for me personally as a consumer. Okay. When interest rates go up, when the bank charges you more interest on the money you borrow from them, I have a question. I haven't even looked it up yet because I barely look at this thing. But for the average American, shouldn't the money they put into savings, shouldn't that APY go up? If
they should,
it should. So let's look at that. I don't even know.
I mean, they're making up half that money anyway. Like, it's just made up money.
So today's savings interest rates. Okay.
I mean, they're making 7%, but what is 7% on money that's not even yours? Like,
yeah.
What's your return?
Okay.
Phenomenal. That's what it is. We need to start a bank.
Absolutely, Ray. Let's ugh. All right. So best savings account rates right now are 0.5, 0.5, 0.5. Now, this is significantly higher than it was for the last few
Oh
years,
yeah. Oh yeah.
but it's still significantly lower than what they charge right now. Okay. Thank you. So it's very important for us to look at the numbers before we before we start reacting to these things. And again, it's all about solution-based strategies here. So to me as a consumer, I see this and I'm like, okay, so you're charging us 6.75 on mortgage rates, yet you're only paying us 0.5% on the savings that we put into your bank so you can lend out to other people for thousands and thousands more times more, basically. A lot of you don't realize that, but that's basically it. you know so just realize that we see a problem, right? So what do we do to fix it? What do we do to solve it? What do we do for our solutions? And for me, it's all about I and after all these years of going through the roller coasters of finance, even through the crash, just doing the math from them and what we're dealing with right now, nothing has ever worked better, according to the numbers that I run. Nothing has worked better than using these strategies, a velocity banking strategy or sweep strategy or whatever you want to call it. It's a credit banking strategy is probably the most, I guess you could say, in tune or correct type of name for it, because we're using credit to bank, right? Much like how banks use our money to bank, much like how corporations use borrowed money to run to bank and everything like that. So why not act like them? Why not do what they do? And within our means, within our limitations, and with the products that they have the same products, guys, as us. They have sweep accounts, they have money market accounts, they have big very commercial lines of credit out there. They use these tools to save interest for themselves and improve their cash flow or manage their cash flow better. Why not us? And so that's why I always bring this to everybody. There's nothing better than using the velocity banking strategy.
Absolutely. Yeah. I'm excited because for a little while there I was feeling I wouldn't say defeated, but the impact was still great. Like the results were there.
Mhm.
And I'm crunching numbers. I'm like, the savings dropped, but they were still there. But when the interest rates on mortgages got really low, I was like, man, it's we could still save some.
Yeah.
But when these interest rates go up, it's not just some, it is substantial amounts. So this is coming back into the age of, velocity banking's always been good. But this is back when it gets real good.
Yeah. Yeah. I mean, I'm excited because I'm a person who does share the velocity banking strategy with everybody. And with these new rates, it just makes it so much easier to share. I could impress you with numbers all the time now. It's so fun. Um, so it's very, very interesting to see what's going to happen here very soon. I already seen people scrambling. So check this out, Ray. We haven't even gotten title yet on this property. We're supposed to in the next few days, if not early next week. Okay. Crossing my fingers that we finally close. But there's a buyer already who wants it as is. They just want to take it right after we go in. With
All right.
Yeah, and they've already met our price. It's crazy, but we
After
put the
repair
price up.
though, or
No, they want as is. They want it
perfect.
as is. And we got an appraisal done, then that's basically the number that we wanted to use. So hey, if somebody wants to take this as is, we're going to use the appraisal as the sale price. And they met it. They're they just want it done as quickly as possible.
Wow.
And this is all just kind of like fitting correctly into everything that we're trying to do here with this particular situation. And plus, since I'm moving, I don't want to spend too much time on this place. And with all the repairs and everything like that that would need to happen on this particular property, it's probably going to take a lot longer than I wanted to. It's probably gonna be more expensive than I want it to, because with all these rates going up, I don't see the lumber prices dropping anytime soon. I'm waiting for that. But how about you? Are you seeing anything as far as materials and labor kind of like starting to stagnate or drop?
No, I see them going up.
They're going up.
They're going up.
What's going
They're
on?
going up. Yeah, we're back up there.
Yeah.
And so what I do see is the higher end homes more are kind of I've seen some cancellations coming back on the market. I see more, like I've seen some new ones. Not sure if they're new or whatever. I know a couple of folks that literally have been looking in the $500,000-$600,000 range. And I've told all of them, I said, I mean, because there's 4 in particular. I said, this is important to understand that you're not under contract, and this is something that they're just friends from church, and so
Gotcha.
their realtors have talked about this. But one thing that they haven't really talked about with the loan officers, because they're not under contract, is locking in rates. And a lot of folks, especially like new time home buyers, you can lock in a rate when you're under contract with a property.
Right.
And but if you've been looking for a month or two now and you got pre-qualified back at when rates were 4.5 and so it can create a little bit of an issue there. And I'm seeing that on the higher end price homes, which makes the like in Tucson, I would say the average sale price is right around 300. That's where we're at right now. So the house is at 300, just can't stay on the market. Those have actually ticked up and are extremely scarce now. And so what everybody's doing that has those is bumping their prices by 50,000. Yeah. But hey, I like the idea, and I don't know if this is too sensitive to ask in the middle of the deal, but on your deal that you're working on, because we got a lot of folks in here who are interested also real estate, fix and flips, and items like that. So this fix and flip deal that you have going on, I always love talking about the deal too. So you found this deal, and basically this deal is kind of just on paper right now. You just really have a contract to purchase this, and you're in the process of purchasing.
Yeah, we're right in the process of purchasing. We're on the very tail end. We're just because the appraiser took forever to get the report in, and I'm using hard money, so that delayed everything basically. And now that we have the appraisal in place and my loan is pretty much approved and ready to go, they're just in the very back end of underwriting and closing. So
this is a little bit different than a wholesale. So you're actually going to complete the close, almost like a double close. Basically, you're going to complete the close, and you have somebody already there to immediately go under contract again.
Exactly. The thing about wholesale is that, unfortunately, if we had to do a wholesale, then we would have to spend another 45 days of loan approval and everything like that. The original bank who's holding the lien on the property was in the process of foreclosing already, and they don't want to wait anymore. So we have to keep this particular process ongoing. If the bank wasn't an issue, I would have dropped my lender and went straight to a wholesale. For the new appraisal costs and everything like that, would have been a heck of a wholesale fee, I must say. but because of the bank wanting to get it off of their hands already, I mean, just last week they were actually threatening to change the locks,
Ooh,
but I ended up calling them and putting them at ease. As, look, we're trying to close. We're very close. It was the appraisers that took forever. I may have to call them again because it's supposed to be the end. It was supposed to be tomorrow that our final closing is supposed to happen according to them. But I'll be contacting them tomorrow and letting them know that we're gonna have to put it off for another week due to the appraisal and finally getting it in, and so we're on the tail end of it all. And they're very they're very receptive of that. They said, as long as you keep us updated with everything, we should be good. So just get it done. I'm like, okay, that's what we got to do.
excellent. I like to
So
hear that. I have another question though.
yeah, go for it.
Because I feel like if I were watching this right now, I'd be thinking this. You're transitioning to sell it right off. So this offer has to be generous enough to think it is not even worth remodeling right now at this offer. Is
Yep.
it something similar in price as far as like your your acquisition to sale price? The difference there, let's just call it the profit margin.
Mhm.
Is your profit similar to what it would have been holding the property and actually doing the rehab?
No,
Is it more?
it's more.
That's fantastic.
It's crazy, but it's more.
That is fantastic. And sometimes this is something that I've discovered. Sometimes um, some refer to it as like a quick nickel is better than a slow dime. But sometimes that nickel is actually a dime, and a quick dime is better than a slow dime.
See
Because
that.
once you get into something, especially a fix and flip. Now you've had a chance to do due diligence on this, but if you say didn't, you're purchasing this from auction or something like that, and didn't really
Mhm.
know and even after you've gone through this property, there's still some unknowns. There could be some things that pop up, extra added expenses, and it could be drawn out. What's your estimate on if you did the rehab? How many months would it take?
Probably be at least 3 to 6 months.
3 to 6 months.
Yeah.
That holding
So,
cost, materials going up.
yep.
Wow.
I got a
Oh,
private lender and I got the hard money lending. So that interest would build up over that term, which is pretty significant at that point. Plus the cost of labor and lumber and trying to get work. Honestly, workers are, well, rightfully slow because they're too busy doing other things. So it's not their fault. Just like the appraisers, right? It's not their fault. It's the fact of the matter is the demand is so high. So we have to, the way I see it is the only way this would actually work for me ethically, Ray, is if it was an end buyer, which it is.
nice.
Okay. So
Very nice.
this is somebody who is buying the house to live in, and they are construction workers. So they will put their sweat equity into the property and get it up to snuff. And honestly, by the time they're finished, I can almost guarantee you that they're going to have a good amount of equity already just by doing their own work. So, I don't see that being that the I don't see that being a bad thing. It's a very good thing for them. And they're locking in because they know it's super hard to find a good deal here in Hawaii. In this neighborhood, I mean, the next door neighbor just listed for over 900,000. That's their starting bid. I don't know where it's going from there, but their starting bid is 900,000. We we got it appraised for as is, as bad as it is. It's pretty garbage. It's still standing. The bones are great. The structure is solid. It's just mainly cosmetics, really. Um, we got it appraised for 780, and that's what we're meeting at.
Nice.
So if I have to put in another $100,000, at least to get the place up to snuff, minus the interest, minus the closing fees and the realtor fees and everything like that, at this moment, this is the best route for us.
Mm,
So we're going to stick to it.
beautiful.
And not only does it, help us profit the most out of it, but also it meets my timeline to because I'm leaving. We have our tickets. We have our tickets to leave. And we got to meet that deadline. So pretty sweet.
Beautiful. Well,
But yeah.
excellent. Man, this is good stuff. Absolutely, Richie. This is great stuff.
Yeah, I'm sorry for having to geek out, but this is just one of those things that again I've gotten feedback from a lot of people wanting to get into a home equity line of credit, and I just wanted to let them be aware, those who are actually asking. I want you to be aware of how they calculate your debt to income ratio now with the new mortgage rates. If you're borderline, then chances are they're going to ask you for cash up front or pay things down. um, if you can meet it, then great. Do your thing, have at it. I mean, we have a bank over here offering a 5-year fixed home equity line of credit, 5 years for 2.25. um, and then whatever you do after that, whatever the future holds, do whatever you need to do. But after 5 years, I mean, you could do a lot of damage in 5 years using this strategy. So like we have, we did it in 6 years. So um, yeah, I'm just saying that there's a lot of things that could happen, really good things that could happen within that range, but also there's a lot of bad things that can happen. So be prepared to react. So whenever something fortunate happens to me, Ray, uh, the old me would always say, "Oh man, so lucky," or "It must be nice," right? But the new me is like, "Am I lucky or am I ready?" And I'm always very grateful to keep myself prepared for anything that comes up, any opportunity that comes over my head. I'm going to snag it, and I'm going to keep it. I'm going to do something with it. um but yeah, is it okay if I answer this question by Johan?
Yeah, yeah, definitely.
So how do I do velocity banking with a large mortgage on an adjustable rate? It's a great question, especially right now. If this person or somebody has an adjustable rate, it's going to kick in here pretty soon. I believe that there was a certain month or date where the adjustable rate kicks in, depending on how your adjustable rate mortgage is modeled out. There's a 10-1, the 7-3 or 7-1 or 7-2 or 5-1, whatever type of structure the adjustable rate mortgage is at. At this point, I'm assuming that if somebody stuck to an adjustable rate, that means that they couldn't qualify for a refinance before all of these before these rates are starting to go up. I could only assume that. I don't know. Maybe they just didn't want to refinance. Maybe they saw that a refinance starts the clock back over, but it locks them in the fixed rate, and they could do everything, whatever. But the last person that actually had helped with an adjustable rate was around 5 years ago. And they actually had the adjustable rate from before the crash, which is really interesting because most adjustable rates before the crash here locally in Hawaii got refinanced. And I know that there's a lot of adjustable rates on the mainland that got foreclosed on or refinanced, depending on what the situation was. Majority of them foreclosed. We saw that in the news. But for them, it was all about just making that minimum payment. They had their situation was they were both contractors. They only did contract work, not construction contractors, but just contract work. Meaning that they only were their pay was based on commission, whether it be sales or whatever. And in their situation, it was basically up to them on how much income they made. There was no grinding the hours to make the dollar. It was basically how, clothes to put the food on the table, clothes to keep the house, and so on and so forth. And they must have been really good at what they did because after all those years of making adjustable rate mortgage payments, their balance didn't drop. they just kept paying the bare minimum interest payment statement payment that always came in every month. And then just like most people, they would spend the rest. That's their cash flow, their leftovers after all expenses. They did such an amazing job putting it out to close the sale and everything like that. So they're just going to treat themselves and break even every single month. um in their case, I basically had to help them adjust that mentality of keeping more of that cash flow and start using a line of credit, personal line of credit in their case, because they couldn't get a home equity line of credit due to the fact that the home value was still lower. I'm sorry, it was their balance is still higher than the 80% LTV that they had at the time. So they couldn't get a HELOC. They had to use a personal line of credit. But with that, the banks are having a hard time looking at their income because they wrote everything off. They're both contractors, so it's really hard for them. So I'm telling you the story because this is the last time. This is the last time I helped somebody with an adjustable rate. And what I had to do is basically convince them to increase their cash flow, use a savings account, or even a secure line of credit to open up and improve that relationship with the bank, and then start using that as their tool to start chunking the adjustable rate mortgage down while they made minimum payments to the mortgage. And when that calculated out, um, if say they had a good month, they would be able to use that as their test. If they had a good month every month, they should be able to pay the house off in 12 years using that strategy. It's very individualized. So Jan, I'm just letting you know that for this particular strategy, it's very, very individualized. And this is the only reason why I'm telling you the story, is because I can't sit you down and tell you exactly what's going on until you inquire about that. Uh, the only thing I have is a story to tell you that if they kept their cash flow increased and they used the velocity banking strategy to chunk the mortgage down little by little, they were able to pay that mortgage down as fast as possible. Again, it was a 12-year it was a 12-year endeavor according to them, and they wanted to do it. They actually joined our program, and then we met with them every single month. And yes, their income was up and it was down, but they made it work. And I believe the last time I spoke to them, they were in a very positive situation where the value went up, and they were actually in the process of looking at getting a home equity line of credit done on their property to flip it out of the adjustable rate mortgage. But at that point, they had to, of course, show the income. They had to record it correctly. They had to not write off as much. They had to pay their taxes to qualify for that. So that's the last time I spoke to them, is that they were still in the process of trying to qualify for that. I haven't gotten an update because I haven't worked there ever since. But I can imagine with what the work they put into it at that point or thus far, I can imagine that they kept going. I can imagine that they used the strategy to get to the point where they needed to go ahead and get themselves into a better bank product to work with. I'm not saying that adjustable rate mortgages are bad, especially for them. During that time, their rate was actually really good. It was great, in fact. The payment was so low that it was just like, we can make that in a week type of thing, and whatever they do in that week, everything else would just be bonus. So when we're looking at the new rates coming up right now, however the banks adjust, because right now I'm looking at adjustable rates right now, and they're all over the place. I got a bank that's doing 3.75. I have a bank that's doing 7%. So they're all over the place right now. And depending on how the bank adjusts with the person who's holding the adjustable rate mortgage, I guess that's going to be a conversation. That's going to be a whole new reaction on how to fix that. So for them, we were able to create a plan out and make it work. For someone who's just asking, how do I do velocity banking on a large mortgage adjustable rate? I'm sorry, but there's no blanket strategy for this. This is a very individualized question, especially when I don't have all the information such as incomes, expenses, and credit scores, and what the bank looks at you as far as debt to income ratio goes. So until I have that, I can't definitively answer your question, but what I can do is just tell you a story. So
Man, that is awesome. Actually, now that I think about it, we have done, as far as wise guys and ties, I believe we have done well over 100 case studies now online.
yeah.
Easily 30 or 40 with you, and I know probably well over 50 with Joseph. And
Yep.
I do not believe we have ever done an adjustable rate mortgage. Now, maybe we did not know it was adjustable rate, and the rate they gave us was at that time. But that is something that it is something that, one, not many people have experienced handling it. So, but I know, Richie, you've dealt with this several times. So I know that you have experience with that. And so anybody out there that, hey, is thinking, okay, how do I exactly handle this situation? Well, there is an easy solution to that. I'm just going to go ahead and, kind of wrap up tonight, but let you know that you can always reach out and get more help with this. So I'm going to go ahead and share my screen real quick. If you go to wiseguysinties.com and you go over here to the personal credit and velocity banking tab, when you click on this, this basically is going to show you how you can get your specific situation fixed, handled, solved, planned. And really, it depends on where you're at, because we have 3 different ways to really meet you where you're at. So it really depends on what it is and what works best for you. So if you're just looking for the equations, the handbook, the guide, a useful tool that you can use to implement and plan your own strategy, then all you really need is the Credit Banking Book by Joseph Smith. Now, what I always recommend that you go through Richie's brand new Velocity Banking course, which is really designed to help walk you systematically through the process and understand velocity banking, so you can start to implement it, from fixing your credit to implementing the different strategies, even advanced strategies. We just put a bunch of videos in there that really starts to deal with advanced velocity banking and wealth building. So if that's what you've been looking for, plug on into this. And then, so if you have a tricky situation, the great thing is you can work with Richie one-on-one, map out everything, bring all the financial numbers to the table. This is a private coaching session. Well, actually, it's usually a few different sessions that kind of work into one. But of course, you have to gather the information and then actually meeting with Richie, and you just meet via Zoom. You get the actual meeting recorded. So there's a lot of information that Richie's going to go over. There's a whole plan that's going to be laid out. So, of course, you want to be taking notes during this, but then you also get access to the whole meeting recorded. So as you're going through your, some of these plans are 5, 10, 15-year plans. You have that video as reference. And then, of course, if anything changes, what do? Well, you just give Richie a call and go from there and correct the plan as needed. And, if you have any questions on how that actually works, you can always give us a call. If you go back to like our main page here, you can always contact us. Our phone number is 888-524. It should be right here on the page. 888-524-9273. Always give us a call. If you call tonight, then leave us a message and we'll make sure somebody gets back with you tomorrow, and you can ask all the questions that are needed and make sure you get a time slot to meet with Richie that works good for you. But other than that, man, Richie, I appreciate you coming up and always just like making me reevaluate, making me think I'm like, hey, okay, where am I at? I got to readjust. I'm really glad that we closed on that property. It's considered an investment property, a 30-year mortgage on that at 4.5, what, 2 months ago. So I'm like, whoa, we'd be looking at 8% now in just a matter of 7 weeks. That's wild. It's so wild. It's not like it just changed over 2 years. It literally changed in 2 months. This is craziness.
Feels like a couple weeks to me, man. Like I swear to God, I was looking at 3.75
Like
two,
4
three
weeks
weeks
ago.
ago. Yeah.
It's nuts. It is nuts. Giving it the benefit of the doubt, but man, this is speed change, which historically, things like the stock market move quick. Real estate tends to move slow. So it'll be interesting to see if this actually speeds up any type of movement, shifts, slowdowns in the market. I don't think anybody's going to have time to react yet. So real estate's always historically moved slow, but things are happening. Got to be watching. So, Richie, thank you again. I really appreciate it. Thank you, everyone who tuned into the Zoom call, who is joining us on YouTube. We appreciate everybody being here tonight, and we will see you in 2 weeks on Thursday. I always recommend you can join our Facebook group. Of course, you can always find the link on our YouTube videos under wiseguysandties.com.
Thank you guys so much.
All right. Good night, everybody, and God bless.